My name is Alex Conconi. I'm the founding partner of Conconi Growth Partners, a private investment company based in Vancouver, where we invest with a focus on real estate, technology, and mortgages, including the founding investment in Neighbourhood Holdings. Over the last year, we've seen interest rates skyrocket faster than anyone alive on a percentage basis. We've also seen the most immigration to Canada that we've had on record. Yet housing inventory and unemployment continue to be super low. And I think I saw this morning that housing prices have actually started to go up again. So what does all this mean? This year, our team's been doing a series of calls with experts at the top of their field to help us understand what's coming around the curve. And today, I'm really excited to have as my guests Benjamin Tal, the Deputy Chief Economist of CIBC, one of Canada's oldest and largest banks, as well as Taylor Little, CEO of Neighbourhood Holdings, one of Canada's most exciting alternative mortgage lenders. So to kick us off, I'm really excited to watch with you a presentation from Benjamin Tal, who's going to share his perspective on the data he's seeing from across the Canadian economy. Then afterwards, we're going to bring Taylor Little into the discussion and ask some more specific questions. But before we get started, let's do some quick introductions. So Taylor Little is CEO at Neighbourhood Holdings. He's also a good friend of mine. He happens to be an amazing cyclist. Taylor, could you tell us a little bit about Neighbourhood Holdings?
Yeah, thanks, Alex. And thanks, Ben, for giving us your Friday afternoon. We know you're on the East Coast, so we really appreciate you joining us today. Neighbourhood is an alternative mortgage lender, which means we sit just outside of the prime space, which generally speaking is the banks and a few others. Our business is focused on borrowers in transition, and we lend across the country in major urban markets. We provide temporary liquidity to borrowers. And I think something that's really interesting about our space is when you look at our type of mortgage product, which is typically a one-year interest-only mortgage product, it's very similar in price to what banks charge for a one-year open product. And that's really just a function of optionality and liquidity. Makes it easy for people to move out of their transitionary event. We primarily have as borrowers on our book self-employed Canadians, which is a really interesting part of our business. Around 40% of our book is there. So happy to be here today, happy to talk about what we're seeing, and excited to hear what Ben has to say as well.
Awesome. Thanks, Taylor. Okay, well, next, I think you all know CIBC, and I'm sure most of you already know Benjamin Tal as well. He's a member of the CIBC economics team that is responsible for analyzing macroeconomic developments and their implications for various markets that affect Canadians. He's also a regular commentator in the media. He's well known for his groundbreaking published research on topics such as labor market dynamics, real estate, credit, and more. Personally, I love listening to Ben talk about markets because he has a special way of keeping things interesting. So, Ben, thank you for being here today. I'll pass it over to you.
A pleasure. Thank you very much. Good to be with you. Listen, I have 20 minutes to tell you everything I know about the situation. That's 19 minutes too long because nobody knows. We all make it up as we go. You all know that. However, I'm going to divide my remarks today into three parts. The first part will be about inflation. The second part will be about inflation. And the third part will be about, you guessed it, inflation. And after talking about inflation, I will tell you at the end of the day, this is not about inflation. This is about the cost of bringing inflation down to 2%. Because the Bank of Canada, the Fed, the ECB in Europe, they have established their reputation as inflation fighters. They are not going to, toss it away. They will do whatever it takes to make sure that inflation is back to 2%, even, and that's important from your perspective, even if it means taking this economy into a recession. So it's not about inflation being 5-6% forever. It's about the cost of bringing inflation down to 2%. As people in the industry, you have to remember that. Now, we also have to recognize, now I cannot see the screen. I cannot see my slides. So I hope that, okay, now I can see that. Perfect. Let's go to the first slide, and I'll tell you why it's important. Because this is the first wave of inflation that we are in the social media era. And that's important because people are influenced by that. You can see this chart. This is not a joke. Social media is perceived to be the most credible source of information regarding inflation. So think about it for a second. The Bank of Canada is trying to figure out inflation expectations. Namely, they try to figure out what we think about the economy and inflation. We are heavily influenced by social media, which means that the Bank of Canada is directly and indirectly influenced by social media. That's how crazy the situation is. Now, there is good news. In fact, very good news. the Bank of Canada has a Twitter account. The bad news, next chart, nobody is following them, as you can see in this chart. So the Bank of Canada cannot tweet its way out of inflation. That's the reality, and that's why you have to recognize that when you listen to the Bank of Canada and when you see what they do, totally different things. Same goes for the Fed, because they have to keep the language up because they want to make sure that we believe that they are on top of things. That's more or less where we are. Given this background, now we can discuss inflation. And at this point, there are 5 forces of inflation: food prices, energy prices, supply chain, rent, very important, and wages. Let's go one by one and see where we are in the cycle. Let's go to the next chart. First of all, the very important food and energy prices going down. They're actually negative contribution to inflation. Now, listen, I don't know what Putin will do next. I don't think he himself knows what he will do next. But for now, energy and food are a negative factor when it comes to inflation. Namely, they are going down, as you can see from this chart. That's a major force helping inflation, going down from 7% to 4%. That's one thing. The other is the next chart. Supply chain. Supply chain is extremely important. This is, if you wish, the supply chain headache index by the New York Fed. It's basically back to normal. Shipping costs down dramatically. Shipping activity back to normal. Today in the US, listen to this, you have 20% more truck drivers than before the crisis. So this is going down now. Why is it important from your perspective? Because if all the inflation that we're seeing is coming from supply, then there is nothing the Bank of Canada can do about it, because supply means outside the country. Believe me, Putin does not care about the Bank of Canada raising interest rates. The Bank of Canada, the Fed, can take interest rates to the sky. That will do nothing if all the inflation is coming from outside the country. Every millimeter decline in this black line is enhancing the ability of the Bank of Canada to deal with the situation, because it means less and less of this inflation is coming from outside, more and more it's coming from domestic sources inside, more responsive to higher interest rates. So the Bank of Canada is empowered by this trend and make it more effective. That's very important. Another thing that is happening because of the decline in the supply chain pressure is the next chart. And that's fascinating. That's basically retail gross margins. I suggest that during COVID, many retailers were hiding behind the fog of supply chain. You wanted this dishwasher, you went to the store and they say, listen, unfortunately, China supply chain, we don't have it. We don't have it in stock. However, if you pay more, maybe we'll find one. So we have seen a significant increase in profit margins. Now, with supply chain going back to normal, you cannot hide behind that anymore. So margins are going down. That's a major, major disinflationary force that we are seeing. And that's why, if you go to the next chart, you can see something very interesting. The chart to the left is Canada. Canada is basically more or less at 2% already if you measure it correctly. What is correctly? You look at core, namely food and energy out, always the case. What we also do here, we take interest payments out of the calculation. Why? Because the Bank of Canada is raising interest rates to fight inflation. Now, the way we measure in Canada housing inflation is we look at interest payments as part of this inflation. If they go up, more inflation. We look at commission to brokers and real estate agents. We look at the cost of building a new house. Basically, many components, but one of them, a big one, is interest payments. So think about it for a second. The Bank of Canada is raising interest rates to fight inflation, but higher interest rates mean higher interest payments, which means higher inflation. So you have two forces going in different directions. It's like putting a humidifier and a dehumidifier in the same room and let them go at each other. And that's why we all know that higher interest payments on mortgages is actually disinflationary. Therefore, you have to take it out of the calculation. You do that, and we are already at 2%, and that's why the Bank of Canada is telling you we are done. We are basically done almost. Look at the chart to the right. That's the US. Not there yet. Why? Because again of housing inflation. In the US, they calculate housing inflation very differently. It's all about rent. 30% of households are renters. So what is your inflation? Rent. Fine. What about the other 70% that they own houses? They say, listen to this, that's very important. They say, let's assume as a homeowner, let's assume that you are renting this house to yourself. What will be the cost? A market rent. All of a sudden, 40% of core inflation in the US is rent. And rent is rising by about 7-8%, which means that if all other prices in the US are zero, inflation will still be 3.6% just because of rent. So if rent goes down, it's a major factor that will lead to this disinflationary force that I'm talking about. Let's go to the next chart and see what I'm talking about. There are two lines here. One is basically the black line, which is the floor, and the blue line, which is the stock. Now, the stock of housing inflation, namely rent, in the US is still rising by 7-6%. That's all the lists. Now look at the new lists, which is the black line, basically back to normal. In fact, the actual list is 2%, which brings housing inflation down to 2%. So what I'm telling you here is that slowly but surely, more of the black line is going into the blue line. More of the flow is going to the stock. It's not a prediction, it's a given. Within the next 6 months, we are going to see rent inflation in the US going down dramatically, just because of the fact that the flow is now averaging close to 0% inflation, and the stock is starting to follow the flow. That's a given. That's not a prediction, that's a given. It's only a question of time, how long it will take for the black line and the blue line to merge. That's a given, and that's huge. So you have a situation in which food prices down, energy prices down, supply chain moving in the right direction, and clearly rent will be moving in the right direction. So what's left is wages. What's left is the labor market, and therefore the impact on services. And that's the difference between moving from 3-4% inflation to 2%, which is the target. So let's go to the next chart and discuss the labor market. We all know the craziness in the labor market. We follow the news very closely, and we look at the number one variable there, which is vacancies. Namely, we have 1 million vacancies in Canada, 11 million in the US. And people say, where is everybody? Where are they? Everybody is disappearing. And some people say they're all at home watching Netflix. No. If you look at the participation rate, especially among young people, it's back to normal. So something else is happening here. And I think, and that's extremely important from your perspective, when it comes to COVID, we have to ask ourselves to what extent COVID is an event or a condition. Let's pray that from a medical perspective, it is an event. But economically speaking, given the fact that it accelerated so many trends, it's definitely a condition. Just to illustrate, this is a very famous chart in Economics 101, unemployment versus job opening, vacancy. And you can see that the blue lines, that's before COVID. The black lines during COVID, and you can see the shift in the curve. Namely, for a given level of unemployment, the vacancy rate was higher during COVID. Now, I want you to focus on the left side, where the arrow is. You can see the direction? Slowly but surely, the black line is getting closer and closer and closer to the blue line, which means that the market is starting to normalize. That's extremely important because it means that wage inflation will not last forever. Another interesting example is the next chart, which is the famous Phillips curve in economics, the relationship between the unemployment rate and wages. Again, you go back to before COVID, the black dots, normally functioning, negative correlation, namely the lower the compensation, the higher the unemployment rate, and vice versa. Look what happened during COVID, the blue. Crazy, up and down because of government transfer, nothing worked. It was crazy. But look at the last few observations. All of a sudden, the blue is getting closer and closer and closer to the black, which means that the market is normalizing. Again, very positive signals regarding future wage inflation that will be more moderate than perceived because the market is normalizing. So I believe that many of those vacancies will disappear very, very quickly. The market will be shedding vacancies as opposed to jobs. And that's one of the reasons why we might see what we call a wannabe recession as opposed to a real old-fashioned recession. However, everything depends on monetary policy. Interest rates. I suggest that every economic recession over the past 40 years was helped, if not caused, by monetary policy error in which central bankers raise interest rates way too much. Why? Because inflation is a lagging indicator. Inflation is telling you about the past, not the future. Inflation over the past 5 cycles peaked 6 months after the beginning of the recession. But show me the central banker that will have the guts to stop raising interest rates while still witnessing accelerating inflation. That's more or less where we are. So the question is to what extent the Bank of Canada will make that mistakes. Let's go to the next chart and discuss the Bank of Canada and the Fed. First of all, and that's extremely important from your perspective, monetary policy in Canada is much more effective than monetary policy in the US. The effective interest rate, namely actual interest rates that you pay on debt in Canada, much higher now than it was relative to 2019. In the US, it's still lower. Why? For 2 reasons. One, in the US, all mortgages are for 30 years. In Canada, much less than that. So it's more immediate. The other is you have to go back to 2008. The mother of all recessions in the US led to the mother of all deleveraging. In Canada, this was not our recession, 2008. We were basically second-hand smokers back then. So we did not have this major recession, and therefore our debt actually went up during the recession, while in the US it went down. So we have more debt. You have more debt, you are more sensitive to higher interest rates. How sensitive? I estimate that 1% increase by the Bank of Canada is equivalent to 2% increase by the Fed, and that's why the Fed will have to go higher in order to achieve the same results. So what I'm telling you is that the tiny Bank of Canada is more powerful than the mighty Fed when it comes to monetary policy. By how much? Let's go to the next chart. Namely, how much the Bank of Canada can divorce itself. One of the most significant risks that you are facing in the industry is overshooting by the Bank of Canada. And why you can see overshooting? Because let's assume that the Fed goes crazy. Something happens in the US, inflation is not stabilizing, the Fed is overshooting and going and going and going. How much the Bank of Canada can divorce itself from the Fed? Remember, if the Fed goes and goes and goes and the Bank of Canada does not go, this means that the spread between US and Canada will widen, and that will weaken the Canadian dollar that will be inflationary. The Bank of Canada would like to avoid that. So therefore, if the Fed goes crazy, the Bank of Canada will have little choice but to follow, which is not going to be good because we don't need it. We are just following them because of the currency. So what will be a reasonable spread before the bank moves? I suggest, based on history, 100 basis point spread. Until then, it will be fine. After that, higher than 100, the Bank of Canada will have to go higher. Today, the spread is 25 basis points. The Fed is expected to go 1 more, so we are good. Now, why 1 more and that's it? Because of the banking crisis in the US, you're all aware of that. I won't get too much into it, but what I can tell you one thing, the market is now rewarding liquidity because of the crisis, which means that lending credit will go down. It's already going down dramatically in the US, not in Canada, in the US. Therefore, you don't have enough credit, means that monetary conditions are tightening, and that's doing the Fed's job. And therefore, the Fed does not need to continue to raise interest rates because the market is doing it already. And that's actually saving the Bank of Canada from the dilemma follow or not follow the Fed, because you will not reach 100 basis point spread with Canada. That's more or less where we are. Another interesting story is the next chart. Not only is the Bank of Canada more effective relative to the Fed, it's more effective relative to itself in the past. Go back to 1987, 1990. John Crow, the governor of the Bank of Canada, raised interest rates by 650 basis points, killed the economy, led to the 91 recession and the housing market crash that many of you know and remember. Today we are at 425, less than 650. No, it's not. Because if you compare the 650 to today's debt level, it's actually 300. So today's 425 basis points is more significant than the 650 basis points that led to the 91 recession, if you measure it correctly. That's the story. And that's why when I meet with the Bank of Canada, and I meet with the Bank of Canada very often, unfortunately, I tell them, enough, it's enough. You don't realize how powerful you are. You continue, you overshoot, you take this economy to a real significant recession with blood in the labor market. Stop now and you will be okay. It seems that the Bank of Canada would like to stop now. Of course, depends on inflation, but I think that if the Fed does not move, our call is that the Bank of Canada is done for this cycle, 4.5. Now, one thing that is complicating the trajectory is actually the consumer, which is the next chart. This consumer is loaded. $160 billion of excess cash, because we know what happened during COVID. People got their salary, but they were not spending. $160 billion of excess cash, namely more than you need. And a lot of it now, go to the next chart, is going to GICs, because people are blinded by the 5% GIC rate that you get. So a lot of it, as you can see, is going to GICs, where checkable accounts going down, which means that it's not as liquid as perceived. Also, next chart, very quickly, is that most of this money is held by wealthy people. And their propensity to spend is not as high as less wealthy people. And therefore, this money will not be spent in a very significant way, and therefore it will be less inflationary than perceived. That's the hope and that's the prayer. One more thing that I will mention, and that's the impact on real estate, very, very quickly, and that's the next chart. You know the story on real estate, you follow it very closely. I will not get too much into it, but one thing I will focus on. Immigration, non-permanent residents, and people from Ukraine. Last year, we got 950,000 people into this country. 950K. This year, I estimate close to 1 million. None of them is carrying their house on their back. We are in a major crisis when it comes to supply. What we are seeing now, we'll discuss it maybe in the Q&A, is a very healthy adjustment in the housing market. We'll discuss why in a second and what nature of this whether or not it's a free fall or whether or not it's something that is very healthy. But if you go to the next chart, I suggest that in 2021, 70% of new immigrants arrived from one country, and that country was Canada, because they were students, they were already here. They were foreign students that their visa expired and the government told them, listen, just stay here and apply. 70% of new immigrants arrived from Canada because they were already here. So if you think about it for a second, in terms of new demand for real estate, it was not significant because they were already here. 2022, the demand for real estate from newcomers went up because less of them arrived from Canada. 2023, it will be even less. So now all those people that are arriving, they're actually arriving from outside Canada, and therefore the demand for real estate is much higher than it was in 2021, although the number was very similar. That's something that we can discuss later, but the point that I'm making here is that regardless what we are seeing now, which is a very healthy adjustment after a crazy COVID period in the real estate market that you're all familiar with, we simply have a supply-demand mismatch that will get worse and worse and worse. In fact, we are in a national crisis when it comes to housing, and we desperately need more supply. maybe we can discuss it later, and I will stop here.
All right. Thank you, Ben. That was a really great way to kick us off. So let's bring Taylor into the conversation here. But first, Ben, I need to ask you a few follow-up questions. So you mentioned that banks are going to do whatever it takes to bring down inflation. I wanted to ask, does whatever it takes require us having a recession?
No, I think that if they stop now and they allow what's happening in the pipeline to impact the economy, will be, again, very close to a recession, maybe what I call a wannabe recession, namely GDP will be negative, but employment will be fine. If you overshoot, if you go to 5.5%, 6% overnight rate, then we are in a real old-fashioned recession. And I would like to avoid that. So I think that their goal is to reach 2%, 2.5% and stabilize there. I think they can get there by 2024 if they don't rush. And I think that's a question of monetary policy, whether or not you want to commit this error. And again, we know that you overshoot only in retrospect, so it's easy to say after the fact, but that's more or less where we are. So if they stop here, I think we'll be fine. If they go to 5.5, all bets are off.
Okay, well, so thinking about inflation for another minute here, Milton Friedman's famous for having said that inflation is always and everywhere a monetary phenomena in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. During the pandemic, we saw a rapid increase in the money supply as measured by M2 and other measures. We also saw a lot of people unable to work, which I would think reduced output. Some raised alarm. Others pointed to a new theory coined modern monetary theory, or MMT, which suggested that the government could simply create more money without consequence as it's the issuer of the currency. So, you talked about food prices, energy prices, and domestic versus international sources of inflation. But my question is it fair to say that inflation that we've been dealing with is still fundamentally a monetary phenomena in the sense that Friedman suggested? And what do you make of modern monetary theory?
Yeah, the answer is absolutely yes. Everything is connected. All this demand that we're seeing is connected to the money that was printed. So yes, it's a monetary phenomenon. Now, the MMT is interesting. It's the modern monetary theory. It's not modern. It's not about monetary policy. It's definitely not theory. So I'm not agreeing with that. I think that it was a failure for this theory because they basically say you can print as much as you can as long as the fiscal situation is fine. And we have seen that that's not the case. So I think that what we are seeing now is definitely a derivative of a huge increase in the money supply. And now we are seeing money supply going down. That will take inflation back to where it belongs. It was an experiment. Have we done too much? Clearly. Listen, governments spend a lot of money on stuff that they didn't need, but that's easy to say now. I remember the days, and I was vetting some of this program with the government. People were panicking. We put together, the government put together programs that require 5 years of planning in 5 minutes. Just pay. And we now know that many businesses that didn't need the money got it. Many individuals that didn't need money got it. So a lot of money was spent. This money went to deposits. That's why we have this huge excess deposit balances. That's inflationary. Now the government, the Bank of Canada is doing the opposite. The Fed is doing the opposite. We have quantitative tightening, remove liquidity from the market. That will take a while, but money supply is already going down. That's positive.
Okay, interesting. Well, let's go deeper on interest rates here for a minute. From what I understand, a lot, maybe even the majority of Canadian mortgage holders haven't felt the impact of the rise in interest rates yet, thanks to either having a fixed rate mortgage or the fact that most Canadians' variable rate mortgages have static payments. It was really interesting to see that chart that you showed of Canadians versus Americans, and I hadn't really thought of that. The idea that we're more sensitive than the U.S. is, but right now, so far, most banks still have low delinquency. You showed us in your slides how excess cash is still rising, but we're also starting to see a slight rise in consumer insolvencies. And so my question is, how much longer do you think Canadians can hold out without an increase in delinquency? And is there another shoe to drop, or can Canadians continue to weather this rate environment indefinitely?
Yeah, actually, I'm going to release a paper in a few days from now. It's called When Higher Interest Rates Break the Consumer's Back, which is basically what you're asking. Listen, I'm not a Pollyanna here. I think delinquency rates will be rising, and that's part of a healthy adjustment. this consumer is much healthier than in any other episode of higher interest rates because of the relatively low interest debt service ratio, the starting point. Even now, after all those increases, debt service ratio is more or less the same as it was in 2019. With all the increase in interest rates, it will rise, but it will not be dramatically higher. Now, the composition is different. Interest payments rising, principal payments are going down. And that's clearly what you're referring to in terms of the overall situation when it comes to variable rate mortgages. So we have a situation in which at the margin, especially when we're dealing with the COVID core, 2020, 2021, when they adjust interest rate payments, that will be a major shock. By then, however, interest rates will be lower. And we can discuss later, if you wish, where I see interest rates going in the future, namely the next 2 to 3 years. But there is no doubt in my mind that we will see delinquency rates rising. It's not a recessionary story. It's not that people will be, jumping from the window. It's not 2008, but delinquency rates will be rising. That's a given.
Okay, well, I'm definitely going to ask you a question on that, but first I want to pull Taylor in here. Taylor, you're an alternative mortgage lender. Neighborhood aims to serve borrowers who are in transition, and some might say could be more vulnerable to inflation and interest rates as compared to the average bank borrower. If there was another shoe to drop, presumably Neighborhood would be one of the first to see it. How has the rise in interest rates affected Neighborhood's portfolio and your business?
So one key part about Neighborhood's portfolio is it's almost entirely variable, and every single rate hike that the Bank of Canada has pushed out has gone right to our borrowers. So we sort of see in real time how borrowers are responding to higher payments. We've seen delinquencies increase, but they're increasing off of a near zero bottom from sort of 2021. So right now we're trending in that direction of, kind of like Ben was suggesting, similar levels to 2019 delinquencies, which was sort of pre-COVID era, more or less a normal era, and they're holding firm at about that level. So we're watching it really carefully, but we're seeing in real time how people are adjusting, and they're adjusting fairly well.
Okay, well, that's great. Ben, I need to get your view on interest rates here. You've spoken about a number of deflationary or disinflationary forces that are at play, which in aggregate could presumably allow central banks to bring rates down. How long do you see how long do you see interest rates staying at this level? And and if they do go down, will we ever see the lows of the last decade again? What's your view?
So first of all, just one note on the delinquencies. Totally agree. One of the reasons why the delinquency rate is still relatively low, and remember, whatever increase that we're seeing is from a very, very low base, is because of the labor market. At the end of the day, it's the unemployment rate that determines the delinquencies. As long as the labor market is strong, and it's very strong, delinquency rates, despite higher interest rates, will remain relatively low. That's basically the story. And that's why the importance of not overshooting is so significant. Because when you overshoot, you cause some blood in the labor market, and that's why you feel delinquency rate rising. So that's why I keep telling the Bank of Canada, and I meet with them very often, unfortunately, I say, enough is enough. There is more damage to come, so stop now. That's one thing. Regarding interest rates, the market is pricing in the Bank of Canada actually cutting in the second half of 2023. I don't think they will, quite frankly. I think before the cut, they want to make sure that inflation is 100% dead. Because they don't want to repeat the past mistakes of the 80s when you had a double depreciation because inflation went down for 2 minutes, they raised interest rates, and then they killed the economy again. So they want to make sure that inflation is 100% dead. So I say early 2024, the first cut. But then, by how much? We started this madness at 175 overnight rate. 4.5 now, staying there until, let's say, 2024, cut. By how much? I said to 275. Maybe 100 basis points higher than before. Why? Because we have about 4 inflationary forces that we have to recognize. We have deglobalization replacing globalization. That's inflationary. We have just-in-case inventory replacing just-in-time inventory. That's inflationary. We have a labor market that is not as giving as before. That's inflationary. And let's face it, all the green initiatives are inflationary. All those are inflationary forces in the background. The target is still 2% inflation. We can discuss until we are blue in the face to what extent it should be 3%, but they're not going to change it anytime soon. So 2% target, more inflationary forces. By definition, interest rates have to be higher than before. 2.75, 3, a reasonable new normal.
Okay. Very interesting. We're definitely living in a changing time here. One thing that's been pretty consistent over the last while and seems to be still going strong is the housing prices. And I mentioned earlier, housing prices are still going up. It's still difficult to find a home. You talked briefly about immigration. With these record levels of immigration, one of the things that strikes me is that whether someone's a permanent resident or a temporary worker, they still need somewhere to live. And you also mentioned the importance of rent to inflation. And so my question to you is, I think I know your answer, but are we building enough homes? Do we need to do more to build more homes faster? And do you expect immigration to continue at the same pace that it has been?
Well, we are not building even close to what we need to be building. And immigration is rising very fast, but it's not just immigration. Immigration is secondary. Immigration is only 450. We're talking about 1 million a year. So we have non-permanent residents, we have people from Ukraine, we have students, we have so many people entering this country, and all of them need a place to stay, as you suggested. We are in a national crisis, I believe. I had a meeting with Mr. Ford here in Ontario. I told them the next elections will be on that. I told him Vancouver, Toronto, eventually will have civil unrest. And I'm not kidding. People have to live somewhere. And people are getting desperate with the price of rent and the price of housing. It's totally unaffordable. And governments are starting to realize that. The issue is that the level of government that creates demand, namely the federal government, is not the one that is generating the supply. So it's the mismatch, and they really don't talk to each other. And I believe that a rental solution must be a big part of the solution. Namely, we are now canceling projects because of the cost and everything else. So you have more and more people entering the country, and we are canceling projects. You don't have to be an economist to see what will happen a year or 2 years from now. I believe that we need to focus on purpose-built rental. I want to create a situation in which you are 35 years old, you are married, you have 2 kids, and you are renting, nothing is wrong with you. That's the mentality that we have to develop. The only way to do it is to provide a significant inflow of new, fresh, purpose-built rental units. And the only way to do it is to provide developers with incentives. I say eliminate HST, eliminate development charges. And all of a sudden, many of those pension funds and REITs that actually in this space are telling me a no is turning to a yes. For the government, eliminating this, the federal government, is basically a decimal point. So basically, you transfer this money to the municipalities that don't have taxing power and allow them to do that. That's a simple solution. And for this amount of incentives, get more zoning, get more affordable housing. You can do a lot of things, but first of all, you have to make sure that it makes sense to build. Mattamy, the largest builder in Canada, is building more houses in the US than in Canada. You tell me.
Yeah, that seems pretty crazy. The provincial governments in Ontario and BC have both announced their own measures to try to address all of this, to remove red tape and accelerate the creation of more housing. But they also have some interventionist measures in terms of managing how rent can be adjusted and that sort of thing. Do you have any insights or opinions on whether those plans make sense and if things should be done differently?
Yes, I think that the issue, of course, and that's a fear, quite frankly, is rent control. Rent is rising very quickly. And I can understand the cry. I can understand the issue, and the politicians are jumping on that, and totally rightly so. However, somebody said once in Sweden, an economist from the left, he said, rent control is the best way to destroy a city, maybe besides bombing. And there is something to it. Because what is rent control? You're subsidizing current tenants at the expense of future tenants. Nobody will be building. So I agree with the provincial rent control policy in Ontario, for example, where you provide rent control to existing ones, but not to new ones. So you generate more incentive to build. Combine this with incentives in terms of the financials, and all of a sudden you have a boom of purpose-built rental that can really help the crisis. Same goes for Vancouver. The good news, governments are getting it. For the first time, they are using supply tools as opposed to demand tools, but they're moving way too slowly.
Mm-hmm. That's very interesting. Subsidizing current tenants at the expense of future tenants. I'm going to remember that. So, Taylor, immigration is a part of what makes Canada great, but it can often be hard for those who are new to Canada to qualify for financing to buy a new home. They don't have a credit history. They might not have their income situation, at their optimal level just yet, but they might have some savings that they've brought with them. How important is the alternative mortgage industry to helping those who are new to Canada?
Yeah, I'd certainly say we're a really helpful or supportive component of the industry on that front. We do lend to those type of borrowers and help them establish their credit history, help them establish their banking history, and help them get into a home in Canada. So it's not a huge part of our business, but definitely something that we support. And I can appreciate how difficult it must be to move to a new country, and love the line that you don't bring your house on your own back. You need to start somewhere, and we're here to support new Canadians in their housing journey.
Awesome. Well, let's pivot to productivity. We've got a proud tech community in Canada, and so it will likely come to surprise to some anyways that the OECD has Canada ranked dead last of all the advanced economies in the world in its projections for real GDP growth per capita to 2030 and beyond to 2060. We're behind Britain, Australia, France, and Italy. In fact, even Chrystia Friedland has identified productivity as the Achilles heel of the Canadian economy, I think she called it. So my question to you, Ben, is what do you make of Canada's productivity situation, and what's it going to take to get Canada on a better path? Can we do it?
I think we can do it, but I think that all countries will be doing it soon. I think that we are reaching a point in which companies will have no choice but to invest in productivity enhancing activity. What I mean by that is that all those inflationary forces that I mentioned earlier, deglobalization, just in case inventories, wages, and green, they're all putting negative pressure on profit margins of corporations. Until now, profit was easy. Everything was there. Globalization was helping. Just-in-time inventories was helping. The labor market was giving. So profit was elevated. There was no motivation to invest because the profit was there. Now, profit is down because of all those forces, and they will make the life of CEOs even more difficult in the future. So as a CEO, you have to make a decision. Do you just pay or you do something? They will do something. This something will be investment. For the first time, investment is not a nice thing to do. It's actually necessity to survive. Investment means productivity because they will be replacing labor with capital. That's exactly what we are going to see over the next 5-6 years. That's the very definition of productivity. And if I give you 10% increase in your wage and you are 10% more productive, that's not inflationary. Productivity is the number one shelter from inflation. So all countries will be doing it, including Canada. So I think that in absolute terms, productivity in Canada will be rising. The question is whether or not we will be able to gain market share relative to other countries. That's a totally different discussion.
Interesting. Okay. Well, speaking of productivity, since ChatGPT was released a few months ago, it's become the most successful product launch in history, reaching over 100 million users in only 2 months. Since it came on the scene, the pace of development and accessibility of artificial intelligence has skyrocketed, and many businesses are working it into their process. So question for you, Taylor, I wonder, is Neighbourhood made use of ChatGPT internally at all?
Yeah, we have played around with it a little bit, and we've built a tool that we've integrated into Slack that's kind of useful, just sort of an internal tool to help teams find data. I do think it'll be an interesting part of most businesses going forward, and really, really curious to see what more we can do with it. We spent a lot of time developing some in-house tech, sort of to Ben's point, really investing in productivity and the tech stack, and even brought on a really great development engineer to help us with that. And all of a sudden we get this new tool that I think can do a lot. So even from our perspective, thinking about things like using it to help with underwriting, helping it with just recognition of data, whether it's big data sets on delinquency, big data sets on new origination, sales, all that kind of stuff. I think it'll be really, really interesting to deploy it. And we're just at the really early start of that trend.
That's very exciting. Question for you, Ben. Have you played with ChatGPT, and how are top economists like yourself factoring ChatGPT and AI into your projections for productivity, inflation, and potential impacts on the labor market?
Yeah, definitely I did, and I think it's an extremely important. And one thing I can tell you, we should not resist it. I know that many people resist it, especially in the education. I said the opposite. This is technology. Never fight technology. Change the way you think about technology, but technology is there. And the people, the students that are now in the in school, they will be in the labor force until 2060, whatever. So, can you imagine what kind of technology they will be using? So we definitely cannot resist it. And that will have winners and users like any other thing. Every revolution that we went through had winners and some losers. And we are going through a major issue in which there will be some losers. Some people will be losing their jobs, and that will have a negative impact. And that's why education is so important. We have to adjust education, rethink education in a very significant way. Going back, also, we have to find a way, talking about productivity, to build differently. If you look at the real estate industry, in terms of innovation, it's the last in Canada over the past 10 years. So if we talk about supply, it's not just about more labor, because we don't have enough labor. It's also building differently. I'm talking about factory-made houses. I'm talking about 3D. I'm talking about different ways, use technology to ease the pressure on the market. I think that's the direction we're going as well. And I think that the Ontario government is going to participate in a PPP, private-public partnership with some companies. There is a company in Canada called, in Toronto, called the R Labs, which is an umbrella company for startups in real estate. They are using AI and other tools. I think we should use this to ease the pressure in terms of the way we build.
Makes a lot of sense to me. Okay, well, Taylor, you mentioned using AI for underwriting. I wanted to ask about the potential for some changes to B20 and the OSFI's mortgage underwriting guidelines. I'm sure both of you know they've kicked off a public consultation on B20 guidelines, and among the new measures being considered are the potential for a loan-to-income ratio requirement and new limits to high debt service ratio lending. As we know, interest rates have risen really fast this last year, and many people are struggling to qualify for a mortgage already. So some commentators are arguing now isn't the time to make qualifying even harder. But OSFI Assistant Superintendent Tolga Yalkin has been quoted by MortgageLogic.news, I think just yesterday, saying that some have questioned the need for this consultation, arguing that our underwriting standards are even too restrictive given low delinquency rates. I'd note, however, that arrears are a lagging indicator of risk. Low delinquency rates can quickly turn, as we saw in the US through the 2008 global financial crisis. I was just quoting her there. So first question for you, Ben, is what do you think of debt to income as a qualification metric? I know it's not one that's traditionally been used by lenders, but it is one that a lot of commentators have pointed to over the last decade as being, getting into some seemingly crazy places. And how valuable of an indicator of arrears do you think that, or have you seen it to be? And is now the time to make mortgage qualification even harder?
Yes, I don't think it's relevant whether or not we say it's time or not time. They will do it. They will do it. I deal with them on a regular basis. They are very serious about it. They don't take any chances. That's their job. And if it means a more restrictive mortgage market, so be it. So I think that many of the things that they talk about will happen. I was always for the stress test. I thought that it was the right idea, and in fact, it saved the industry, in my opinion. However, it also has to be a dynamic tool. You cannot have 200 basis point spread when interest rates are 1% and when interest rates are 5%. It doesn't make any sense. You have to adjust where you are in the cycle. That's the shortcoming of this policy.
Mm-hmm.
I think that all those measures will happen, and unfortunately, it also means, I think, that it will become more difficult to underwrite in this country. I think that's almost a given, and we have to be prepared for that.
All right. Well, Taylor, as an alternative mortgage lender, you're regulated by different groups of regulators in each province, but you're not subject to the federal B20 underwriting guidelines. So I'm curious, if OSFI moves forward with these suggestions, as it sounds like they're likely to, how do you see that changing the alternative market? And 6 months or a year from now, what will alternative lenders wish they had done today?
Yeah, anytime we see changes at sort of the prime level, the analogy we have internally is we sort of eat the crumbs off the bank's table. So our industry is relatively small in proportion to the prime space. So little changes in the prime space lead to big changes in our space. These rules go through, I think we will see more borrowers go into our space while they work to requalify with their banks under the new B20 guidelines. And I think that's just something that, while it's new, it really reinforces the fact that there might be great opportunities for lenders like us down the road to help facilitate borrowers who are left outside of the B20 guidelines. And so I think one thing we focused on internally is making sure we're very, very liquid for 2 reasons. One is just in case, to your point, if there's another shoe to drop, trying to think whether that's sort of a slipper or a combat boot. If the market crashes, we're ready, we're liquid. And then the other way is if the market picks back up, but it's harder for Canadians to qualify, having that liquidity will be really, really key going forward. So I think things you can do today are just get liquid. So it's just liquid, liquid, liquid.
All right. Well, I've really enjoyed this discussion, but I know we're reaching the end of our time today. So before we sign off, I just want to say thank you to Benjamin Tal for the presentation, and thank you both for joining me for this this conversation. It's been really great to get your thoughts.
A pleasure. Good luck. Talk to you soon.
Okay. Well, on behalf of our speakers, I hope all of you listening have enjoyed the conversation. We appreciate your feedback, so please don't be a stranger. And otherwise, bye for now. Have a great day.